Right now, somewhere in this country, someone is filling out a retirement form at work. Their HR manager points to a box and says, just put in how much you want to contribute and your company will match it. So they pick a number and they sign and they feel good about it and they feel responsible and they feel like they are finally doing the right thing with their money. But here is the question almost nobody asks before they sign that form. When exactly do you want to pay the IRS? Because every retirement account is really just a deal with the government about the timing of your tax bill, and the account you choose determines whether you pay that bill now while you know the rate or later when you have no idea what the rate will be. That one decision made quietly at a desk without much thought has the potential to cost or save you hundreds of thousands of dollars over the course of your retirement. So in this video we are going to follow two people, Chris and Sarah. Same age, same income, same discipline, completely different accounts. And we are going to watch exactly what happens to their money over 30 years when taxes finally show up. Chris and Sarah are both 28 years old, and they both earn $75,000 a year, and they both just decided to save $500 a month for retirement. Same starting point, same discipline, same monthly commitment. But what happens to that $500 is where everything separates. Chris puts his $500 into his company's 401k, and his employer offers a match for every dollar Chris contributes up to 6% of his salary. The company adds 50 cents. That means Chris gets an extra $187 every single month just for participating, and the company puts it straight into his account without Chris doing anything extra. That employer match is genuinely one of the best financial deals available to any working person. It is an instant 50% return on that portion of his money before the market does anything at all. Sarah does not have an employer match, and she puts her $500 into a Roth IRA on her own with no company help and no immediate tax break. On day one, Chris is clearly ahead. He has more money going in every month and his company is helping him build it. But here is what both of them are missing. They are not just choosing an account, they are choosing who gets paid and when, and that choice is going to reveal itself slowly over 30 years in a way that neither of them fully understands on the day they sign up. For the first several years, both accounts just grow quietly, and a dollar earning 7% in a 401k looks exactly the same as a dollar earning 7% in a Roth IRA. But there is a difference that does not show up on the balance screen, and most people never see it until it is too late to do much about it. Every dollar inside Chris's 401k has a silent business partner. That partner has not shown up yet, but he is waiting, and his name is the IRS. The IRS owns somewhere between 22 and 37% of everything Chris is building right now. Chris just does not know the exact percentage yet because he does not know what tax rates will look like 30 years from now, and nobody does. What Chris sees as his balance is not actually his balance. It is his balance plus the government's cut, and that cut will be collected the moment he starts taking the money out in retirement. Now look at Sarah's Roth IRA. Sarah already paid the IRS, and she paid taxes on her income before her $500 ever entered the account. So everything that grows from this point forward belongs entirely to her. No silent partner, no waiting bill, no uncertainty about future tax rates. And what is in her account is hers. This is the core trade-off between these two accounts. The 401k gives you a tax break today and sends you a bill in retirement, and the Roth IRA sends you the bill today so you can have the break when it matters most. Neither is automatically better, but they are very different bets, and understanding what you are betting on changes everything about how you use these accounts. Let us check the numbers at year 10. Chris has roughly $114,000 in his 401k, and Sarah has approximately $86,000 in her Roth IRA. Chris is ahead by $28,000, and anyone watching would say Chris is winning without question. But here is where the scoreboard gets complicated. If Chris retired today and withdrew his balance at a 24% tax rate, he would actually take home around $86,000 after the IRS takes its share. Suddenly they are almost exactly even, and the gap that looked so clear on paper has almost completely disappeared once taxes enter the picture. And Sarah has something Chris does not have. She can withdraw the money she actually contributed at any time with no taxes and no penalties. That is around $60,000 she can access if she truly needs it. Chris cannot do that. If he takes money out of his 401k early, he pays income taxes on the full amount plus a 10% penalty on top of that, and the combination can be genuinely devastating. So on paper, Chris is winning by $28,000, but in reality, after taxes, they are almost equal, and Sarah has a level of flexibility that Chris simply does not have. The scoreboard that looks obvious is not telling the full story. As Chris moves through his 40s and into his 50s, his career takes off, and he is now earning $140,000 a year. He is successful, and his 401k balance is growing beautifully. But success with a traditional 401k creates a specific problem that most people never think about until it is too late, and it is called the tax bracket trap. When Chris retires and starts pulling out $80,000 a year to live on, the government treats every single dollar as ordinary income, and that $80,000 withdrawal could push him into a higher tax bracket than he ever expected. Here is the part that genuinely surprises most people. At age 73, the government forces Chris to start taking money out whether he needs it or not, and these are called required minimum distributions. The IRS has waited long enough, and they want their money on their schedule, not Chris's. Those forced withdrawals could push him into a higher bracket and increase his Medicare premiums and make more of his Social Security income taxable all at the same time. Now look at Sarah. Sarah has no required minimum distributions, and she does not have to take out a single dollar if she does not need it, and she can let it keep growing as long as she wants. When Sarah does withdraw $80,000, she keeps exactly $80,000, not $80,000 minus whatever the tax rate happens to be that year, exactly $80,000. So let us jump all the way to retirement. 37 years of saving and 37 years of compounding, and this is the moment the whole story finally reveals itself. Chris has $1,620,000 in his 401k, and that is a genuinely impressive number, and 37 years of discipline have built something real. But remember the silent partner. At a 24% tax rate, Chris's actual after-tax value is approximately $1,231,000, and that is the number he actually gets to spend. Now look at Sarah. Sarah has $1,178,000 in her Roth IRA, and every single dollar of it is hers with no tax bill waiting and no silent partner collecting a cut. Chris wins on the total number, but Sarah wins on the number that actually matters, the after-tax dollar. And after 37 years, the difference between them is smaller than almost anyone would have predicted on day one. And here is the part worth sitting with. Chris only won the total number because of his employer match. Without that extra $187 every month for 37 years, the Roth IRA would have been the clear winner once taxes were factored in. The lesson here is not that one account is always better. The lesson is that the balance you see on your screen is not the same as the money you will actually spend in retirement, and you do not spend your gross balance, you spend what is left after the IRS takes their share. So what do you actually do with all of this? And the answer is not to pick one account and ignore the other. The answer is to use both, but in the right order. Step 1. If your employer offers a match, contribute to your 401k up to the full match, because this is a guaranteed 50 to 100% return on your money before the market does anything, and you should never leave this on the table. Step 2. After you have captured the full match, open a Roth IRA and max it out, because you are almost certainly in a lower tax bracket right now than you will be later in your career, and paying taxes now at today's rate and letting that money grow completely tax-free for decades is one of the most powerful moves available to most working people. Step 3. If you still have money left to invest after maxing the Roth, go back to your 401k and contribute more up to the annual limit. That is the order. Match first, then Roth second, then more 401k third. Most people do step 1 and stop, or they skip step 1 entirely and jump straight to a Roth, and both of those approaches leave significant value on the table. Every time you contribute to a 401k, you are making a specific bet. You are betting that your tax rate in retirement will be lower than your tax rate today, and if you are right, the 401k wins. Every time you contribute to a Roth IRA, you are making the opposite bet. You are betting that tax rates will be the same or higher in the future, and you are locking in today's rate as insurance against that uncertainty. Chris and Sarah both made reasonable choices, and neither of them was wrong. But they made those choices without fully understanding what they were betting on, and that understanding would have changed how they used both accounts together. So here is the question I want you to sit with before you close this video. When do you want to pay the IRS? Today, when you know the rate, or 30 years from now when you do not? Everything about your retirement strategy flows from the honest answer to that one question, and the sooner you answer it deliberately, the more of your own money you keep. Run your own numbers and look at your current tax bracket and look at the employer match available to you, and make this choice on purpose rather than just signing whatever form HR puts in front of you. Now share this video with someone who has a retirement account and has never thought about the tax side of what they are building, because that conversation might genuinely change how they approach the next 30 years.